Ladies and gentlemen, Assalamu alaikum. Welcome to our webinar on retirement fund management. In this webinar, we will talk about the investment strategies of these funds and clarify the underlying economics of pension and retirement plans. Our webinar is designed to help people in various roles in fiduciary capacity to improve their decision-making abilities when it comes to managing retirement plans. Even if you're not directly involved in managing these funds and are attending the webinar for educational purposes only, we are more than happy to answer any questions you might have and schedule a time to chat further about the topic. So don't hesitate to reach out. Here are a couple of housekeeping points before we begin the webinar. This webinar is being recorded, and we would appreciate if you could hold your questions till the end of the session. However, feel free to type in the questions in the chat box. Before I dive into the actual fund management strategies, it's essential to highlight that retirement planning can no longer be thought of as simply saving enough money for retirement. It requires more holistic thinking. The overwhelming majority of retirees say that all four pillars, health, family, purpose, and finances, are essential to optimizing well-being in retirement. Our social fabric is changing fast, and today's retirees are no longer looking at their offspring as a source of income. Speaking of the categories that retirements fall under, there are two broad categories: defined contribution plans and defined benefit plans. The key difference lies in who is primarily responsible for funding the accounts. Under a defined benefit plan, also known as traditional pension plan, the employer funds and guarantees the employee a specific income upon retirement. Under a defined contribution plan, the employee is primarily responsible for funding their account by deferring a portion of their gross salary, while the employer has the option of matching contributions if they chose. As the defined contribution plans are the focus of our discussion today, I want to highlight the basic motivation behind instituting retirement saving plans, which is to generate adequate income for the participating employees after retirement. In that case, the performance of defined contribution plans should be measured in terms of their ability to generate sufficient income. Therefore, it is assumed that the principal investment objective of such plans is to maximize the terminal value of plan assets at the point of retirement, since that would directly determine the amount of annuity the retiring employees are able to purchase for sustenance during post-retirement life. To illustrate this concept, I have taken an example where an employee contributes 20K on a monthly basis for 25 years. If their investment grows at a rate of 15% annually, the accumulated balance at retirement will be rupees 65 million, which can provide a monthly income of rupees 450K post-retirement. Of course, these calculations don't take the impact of inflation, etc., and the real calculations would be much more complex than this. However, if we change this growth rate from a mere 15% to a growth rate of 20%, the balance is thrice, that is rupees 175 million, and will generate an income of rupees 1 million per month post-retirement. The power of compounding and effective cost management are therefore very essential concepts that should be considered when managing your company's employees' retirement funds. In this slide, I'd like to discuss the impact of cost and how it impacts your retirement balance. Taking the previous example, if the fund has an expense ratio of 2%, it will reduce the balance by around rupees 9 million, and so on and so forth. Moving on to next slide. So now we come to the heart of our today's webinar. What are the best investment strategies you can adopt when managing a provident fund or gratuity plan in your company as a fiduciary? Broadly speaking, practitioners in different parts of the world follow one of these four strategies. I'll begin with life cycle investment strategies that reduce the share of risky assets based on age and the balance of assets in the retirement saving accounts. Most countries have a life cycle investment strategy as a default option. The different possible glide paths include linear decline with age. The share of risky assets decline linearly with age from the beginning of the accumulation phase. For example, the 100 age rule. Second is stepwise linear decline with age. Then there is the stepped decline with age, strategy in which the share of risky assets declines sharply as the individual reaches specific age thresholds. The limitation of such a strategy is such that in case of a sharp drop in equity markets, just before reducing the equity share in the portfolio, the individuals in the plan would materialize the losses by selling equities at bottom prices. Then lastly, we have a gradual decline with age, with the share of risky assets decline gradually with age, but not following a linear function. The idea is to protect the assets of individuals who have already reached large balances with a higher proportion of safe assets, while giving individuals with low balances a chance to increase their balance further through higher return potential. Next, I want to talk about the fixed rate portfolio strategies, which are typically managed by investing in diversified funds like balanced, dynamic, growth, or regressive funds. These are consistent with the objective of maximizing returned income. Most of our local retirement fund managers or fiduciaries follow this style. However, this exposes the participants the risk of experiencing a very large fall just before retirement. These investment strategies rebalance the portfolio every year to keep the weights of different asset classes constant. Third is the default investment strategy, which could include minimum return guarantees. But keep in mind that such guarantees come at a cost. Investment return guarantees provide some protection against financial market risk by setting a floor on the value of assets accumulated at retirement. Lastly, there are managers who would adopt dynamic investment strategies, which is based on a reserve built from contributions or investment returns. Most of the previous investment strategies that I just talked about are deterministic. So they do not adjust the share of risky assets to the market situations. For example, by reducing the share of risky assets following a predetermined glide path, life cycle investment strategies may forego good returns in times when equity markets are booming. Dynamically allocating the assets based on reserves built from contributions or investment returns with the objective to allow the saver to recover nominal contributions. The idea of such investment strategies is that the share of risky assets vary with the level of reserve, which increases when the portfolio performs better than a benchmark return. Given the wide range of possible investment strategies to consider, a pre-selection is necessary. There's a balance to strike the right number of investment strategies for the assessment. On one hand, it's important to assess as many investment strategies as possible to make sure that a potentially good investment strategy is not excluded from assessment. On the other hand, assessing too many investment strategies may be inefficient and may make the results hard to interpret. Most common and familiar forms of private occupational schemes in Pakistan are gratuity funds and provident funds. The Security Exchange Commission of Pakistan has introduced voluntary pension system in 2004. This is a voluntary contribution defined system in which anyone in Pakistan over 18 years with a valid NTN is eligible to participate. The VPS involves several tax incentives to make it attractive to potential participants. Under the VPS, those individuals who are not covered under any pension scheme would also be capable to save for their old age by making tax-free contributions. Under the system, the contributions as well as the gains from investing them will be tax-free. An important advantage of VPS over defined benefit system is portability. Under this system, people will have the power to make decisions regarding the amount of investment, type of investment. Moreover, the savings would remain with them even if they change jobs. The participants in VPS would also have the choice to change their pension fund managers if they're not satisfied with the performance of their existing fund managers. The formal old age income security in Pakistan can be classified into two categories. The first category consists of statutory pensions with provident funds for organized sector employees, and the second category consists of voluntary pension system for self-employed and unorganized sector workers. Post the introduction of VPS, several rules related to VPS and provident fund have been changed, making it very attractive to manage the employee mandatory contribution funds under the VPS structures. Hence, there are two ways to manage the DC plan. One is managing it as a provident fund and the other managing it as a VPS. You can take advantage of external fiduciaries or fund managers and use these typical two ways. Most of the discussion I'll have now in relation to these is keeping in line our digital VPS solution and is very specific to our firm. When managing it as a provident fund, trustees can manage provident funds by investing in voluntary pension schemes as per defined allocation schemes selected by trustees or employees. Transfer of balance from provident to VPS is not eligible for tax credits. However, accumulated balance representing transfer from provident fund may be withdrawn tax-free at any time. Investment growth appreciation is therefore tax-free. It saves time and effort for provident fund trustees, and they don't have to worry about monitoring regulatory compliances. When managing it as a voluntary pension scheme, employers can manage retirement funds by investing as per predefined allocation schemes selected by employer or employees. Direct transfer of contribution to VPS are eligible for tax credit for employees. Employees can claim tax credits up to 20% of their tax income for the relevant year. Withdrawals by employees from VPS are taxable as per the income tax ordinance. It saves time and effort for employers, and there's no need to manage separate financial accounts, and hence no audits are required. JSIL Digital VPS Solution provides trustees with hassle-free management of provident funds. The JSIL Digital Solution provides employers with hassle-free management of retirement, and trustees may opt to provide conventional or Islamic retirement plans to employees by funds, benefits, selecting a consistent or flexible asset allocation scheme for employees as per the investment strategy or employees' risk appetite. Employer can digitally open a corporate account and upload details of their employee, and employee will then receive an email through a digital platform, allowing them to register themselves by selecting the fund, contribution, and asset allocation as per their choice and risk appetite as a whole. Employers will also have access to a dashboard where they can keep the track of as a whole, and employees will also be provided access to keep their portfolio track of their contributions and current value of investments. So this slide, we move on to the key features of the provident funds invested in VPS. Of course, it offers convenience and flexibility because VPS provides a very flexible allocation of money market, fixed income, and equity funds based on all types of risk appetites and make it possible to assign risk profiles individually. Trustees can also control and manage provident funds by investing in VPS as per the allocation scheme of their own choice. Trustees can give free choice to employees to manage their provident funds as per flexible allocation schemes selected by their employees. Trustees can manage provident funds by investing in VPS without the hassle of monitoring regulatory compliances as required under the Employee Contributory Fund and Investment in Listed Securities Regulations 2018. JSIL provides free takaful coverage equivalent to the individual investment in the VPS with a ceiling of 5 million. Withdrawals from VPS and the accumulated balance representing transfer from provident fund may be withdrawn tax-free at any time. Therefore, appreciation growth is tax-free. Monthly installments from an income plan or approved annuity plan after retirement, if invested out of the accumulated balance, can manage extra control over an employee's access to the JSIL digital VPS portal by system checks and controls. In this slide, we talk about the key features of investing in VPS. Convenience and flexibility, of course, again. VPS provides a very flexible allocation of money market, fixed income, and equity funds based on all types of risk appetites and make it possible to assign risk profiles individually in this case. Employer can control and manage these funds by investing in VPS asset allocation scheme of their own choice or empower the decision-making to their employees. Employer, again, may opt to provide conventional or Islamic retirement plans to employees by selecting a consistent or flexible asset allocation scheme for employees as per their own investment strategy or employees' risk appetite. Again, this also saves time and effort for employers as they would not have to manage separate financial accounts and hence no audits would be required. JSIL provides free takaful coverage equal to the individual's investment in VPS with a ceiling of 5 million. Investments in VPS are eligible for tax credits for employees, a maximum of, up to 20% of taxable income for the relevant year. Withdrawals from VPS are subject to deduction of taxes. On retirement from VPS, 50% amount can be withdrawn tax-free, and the remaining 50% is taxable as per the last 3 years' average tax rate of the individual. This can further be saved by investing the balance in approved payment plan or annuity for monthly payment. Monthly installments from an income payment plan or approved annuity plan to manage life after retirements, and employers can manage extra control or over employees' access to the portal by system checks and controls. In this slide, as discussed before, employee retirement funds can be outsourced to professional fund managers. The biggest advantage is the risk management and governance. No hassle to monitor regulatory compliances under employee contributory funds or investment in securities regulations. It's ideal for group corporate structures due to its flexibility. Multiple companies in the group can customize it as required. Further, there's no employee size requirement. It suits both small and large corporates. It is also very cost efficient. It saves time and fund management expenses for the employer. Employers' direct transfer of pension contributions to VPS are eligible for tax credit for employees. Employees can claim tax credit on such contributions, a maximum up to 20% of their taxable income. It saves a lot of trustee time because trustees of Provident Fund can invest on behalf of the Provident Fund Trust, which saves time and efforts for Provident Fund trustees. There are other benefits to employees as well. It empowers their decision making. They can plan their own life after retirement. How much do they invest, for what they'll need for their livelihood after retirement when they don't have an adequate source of funds. It also gives you a big customization and flexibility. So employees have the option to decide and manage their Provident Fund by investing in conventional or Islamic retirement plans, by selecting a flexible asset allocation scheme as per their preference and risk appetite. Again, the insurance and all those benefits which we talked about. And then there is the easy access, because employees will have access to dashboards and portals. They can keep track of their portfolio summary and manage their Provident Fund balance as per their choice in asset allocation. In the next slide, I want to talk about that there are various tasks related to hiring an external fiduciary for operating a qualified retirement plan, such as whether to appoint someone to manage the plan or do it in-house. Taking full control of the plan assets or using discretion in managing the plan makes a defined contribution plan or the entity it hires a plan fiduciary to the extent of that discretion or control. Fiduciary status is based on the tasks and handover the plan and not a title. In fact, hiring a third party to perform fiduciary functions is itself a fiduciary act. This topic has become critical over the years recently for several reasons, including the fact that retirement plans are becoming more complex. The complexity of retirement plans has increased in recent years due to a wide variety of investment options being offered and more intricate tax. Therefore, plan participants need guidance and support to make informed decisions about their retirement savings. Secondly, for more professional setup like JSIL, we are fee-only financial advisors. We charge fees for our services instead of commissions from the sale of products. So we have a fiduciary duty to our clients and do not earn based on the products we sell. Considering all these factors, it is important for fiduciaries to help understand their duties and take appropriate steps to discharge them. It's a positive trend, I feel, and this ensures the retirement plans are managed very efficiently, and the plan participants, which are your employees and beneficiaries, can meet their retirement goals. To understand best practices, let's take a look at what are the top fiduciary mistakes, and later on we'll talk how to avoid it. The first and foremost is the governance. Issues like conflicts of interest and lack of clearly defined responsibilities are common concerns that can lead to liabilities. It's important that as corporate leaders, you should establish a governance structure over your retirement plan with clearly designated responsibilities. These assigned responsibilities should include expert oversight of compliance testing, investment portfolios, and plan analysis. Additionally, someone should be assigned the task of overseeing fees, including keeping track of the amounts of fees actually paid, how fees are generated, who pays the fees, and the fairness of the fee. Formal charts defining powers, duties, and methods of operations should be documented alongside all fiduciary thought process and key decisions and updated regularly based on a plan or personnel change. Second is the investments, or to say investments management. While it may seem like a basic responsibility, mismanagement of plans investments by trustees or the fund managers is a major concern. Often this occurs when a retirement plan offers too many options to employees, making it more difficult to administer it, and also to keep a track of fund performance, including each of the nuances and compliance needs. Therefore, it's important to provide a diversified set of options without creating choice overload for your employees. And so they wouldn't be engaged in very costly mistakes. It's recommended to limit plan choices no more than 3-4 types of plans. And you should consistently be monitoring underperformance and seeking alternative replacements when the time is necessary. This makes it easier and more efficient with less investments to oversee. Third is with regards to compliance. So there could be instances where you're not making timely deductions or meeting the regulatory requirements. It's important to understand what are the ways that they can be found non-compliant. Oftentimes, it's the most rudimentary of planned duties that can lead to liabilities and losses if not performed correctly, including loans and distributions deduction or deductions of the correct allocations from the salaries on a monthly basis, and so on and so forth. So it may seem tedious task to double check the filing requirements or the deductions and using the proper definitions of laws in the Provident Funds rule, but this would help. Lastly, there could be a mistake on the failure to track loan and hardship repayments. So hardship repayments are where some retirement plans permit participants to take out loans. So you are allowing your employees to take out loans or receive hardship withdrawals from the Provident Funds or any other way you're managing these funds. So if they are permitted, you may restrict these type of withdrawals. So in some cases, withdrawals may be taken without meeting the restrictive conditions that the company has implemented internally. So it's important as a fiduciary to fully disclose the terms of their internal guidelines to not only their employees and also monitor it. So now, having talked about the common mistakes, I would like to talk about what should be the considerations and factors when choosing external fiduciary service providers. Number one important is the fees. The fees can vary a lot from one fiduciary service provider to another. So it's imperative to seek and compare the fee structures of different providers to ensure that the employer is getting the best deal. Then there are the services. Different fiduciaries or fund managers offer different service. For example, some asset managers can only offer design and not the administration, while others also offer investment management, and on top of the administration and other services, they also provide you the services of participant education. A financial service and education is a very important concept. You all know how much that's needed in our country. Therefore, employers should select a provider as per their own needs and requirements, but also consider this aspect. Then there is the experience and affiliations. Employers should weigh the benefits and risk of an experienced provider who has been in the business for many years with tons of experience versus the newer ones who might be cheaper and might offer very innovative service, but that services are not that tested, so you may not have to get these vetted. Also important would be the firm's affiliations, financial conditions, and assets under management. Lastly, it's about the investment strategy and reputation. So important it is that you evaluate how the fund managers plan to invest its assets or how it will handle participants' investment directions or your employees' investment direction. And the reputation of the fund manager is a very important consideration. The employer should conduct some background research before engaging with any AMC. And it's also important to know the fund managers who are managing the assets at the end of the day. Many clients have concerns regarding potential conflict of interest when they engage with AMCs. Sometimes clients also doubt if best products are being offered to them or those that are more profitable to advisor. But you feel free to speak about these things, and who can and these fund management companies would address your concerns and assure you that your interests are being put first, and how they assure you, that's for you to test. So that ends up, or basically sums up, our retirement fund management webinar. In the end, I would like to tell you that our digital retirement fund management solution offers a seamless and user-friendly platform, empowering corporations to effortlessly oversee and optimize their employees' retirement funds through a streamlined online process. Simultaneously, it grants individuals complete digital access to their retirement accounts, ensuring convenience and simplicity in managing their financial futures. We'll just run a small video explaining this product, and we'll be happy to take your questions after this.
Introducing a digital retirement fund management solution, specially designed to cater the needs of your company and your employees. Offering stress-free retirement fund management, along with an additional benefit of free life insurance. A few easy steps are all it takes to enroll your company's account. You will start by entering your company's name, email address, and phone number to register the account. In the next step, you fill out your company's basic details, contact person information, and pension fund contribution detail. Here, you can also select if you want to maintain the account or extend the control to your employee. Lastly, upload the contribution details of your employees. You can also consider employee preference and bifurcate them between Islamic conventional. That's it, you're done. After the registration of the company's system, we'll automatically send a user ID, password along with URL through SMS and email to all uploaded employees. After they log in, employees can access their dashboard to see their investment details. If you choose to allow your employees to maintain their account, they will receive a registration URL for individual account opening. They will have to complete the 6-step process to complete their registration. Step 1. Set up their profile by entering their basic bank allocation details. Step 2. Fill in the KYC questionnaire. Step 3. Answer the health questionnaire. Step 4. Upload the required documents. Step 5. Preview all the information submitted. They can even download their account opening form here. Step 6. Finish to successfully open the account. After the employee has successfully registered, they will get access to a dynamic voluntary pension scheme dashboard, allowing them to view their portfolio summary, stay updated with their transaction detail, online investment redemption, access to the latest reports and news, JS Investments, Retirement Fund Management Digital Onboarding, your retirement companion. JS Investments, better investments for a better future. For more information, you can call us at 0800 00 887 or SMS invest at 8027.
Thank you for attending. We are now moving on to the Q&A. So feel free to type in if you have any questions. I have some of those already here. So the first question that we have is, will the disbursement be credited to the employee's account directly? So I believe that's the question. What you are asking is with regards to our digital VPS. So yes, the answer is that the disbursements will be credited directly to the employee's own bank account as per the bank's details that have been provided at the time. So all details which you have provided at the time of registration. The next question is, will there be any cost related to the additional services? So it depends on your negotiated agreement. For additional services, usually our practice is no, but it depends on what kind of additional services. So the one that standardized services that we've already included in the product will not be charged any services, but if there are any customized, then there might be additional charges. I'll take on one more question here, which is, can employees continue the VPS even after leaving the company? So yes, if it's the VPS, under the VPS rules, there is a portability which is allowed, and it's perfectly fine. If you leave the company, it would be transferred. Your VPS balance would continue from your next employer. So this brings us to the end of webinar. I'll just give, I think, 10 seconds more to see if there are any questions. Yeah. So I've answered pretty much all of the questions that the participants have posted. We'll end the session now, and thank you so much for listening. We look forward to hearing more from you. Feel free to contact us on our social media platforms or the numbers that we have given over here, and we'll be happy to answer any questions that you may have. Thank you so much.